Hello, everyone. It's Karl Hannan from LePage Locations North in Collingwood, Ontario. And I'm here with Tara from the Mortgage Center. Tara and I have worked extensively with a lot of clients to help fulfill their needs. So, actually, one of the key elements of buying a home was actually a mortgage. And so, there's lots of intricacies about mortgages and what's available, different plans for new home buyers. And so, we're going to talk about those specific items in this short video. Now, if you like it, please hit the notification icon, click on the bell, follow, share. And as well, below in the description, there's a link to actually book a personal meeting, whether it's on telephone by the telephone or whether it's in person with Tara or myself, and discuss your specific plans. So right now we're actually going to be talking about, okay, well, the approval process.
Mhm.
Okay, how does it work? Okay, go ahead.
How do people get approved?
Yeah, exactly.
So the pre-approval process is so important before you go shopping.
Yeah.
You definitely want to have that done before you actually start going to look for houses.
Hmm.
So one of the key elements is making sure that all of your documents are in order, all of your credit is in order, and that your down payment's in order. Those are the three reasons why deals can fall apart. So those are the three things that we're really checking with the pre-approval process.
Okay. Now, what's the difference between like pre-approval and also pre-qualified? I think there's a difference there, isn't there?
Yeah, so there's the industry has changed a little bit where 5 years ago, a lender would take a look at all your documents, they would take a look at your credit, and they would tell you you are pre approved. That really doesn't exist anymore.
Hmm.
What they're doing now, just because it's so time consuming, they're really offering pre qualifications. So, a pre qualification is where it is submitted to a lender, but they're just doing a rate hold. So they're doing a rate hold for you so that you can go shopping in case there's an increase in the market that you have that rate locked in.
So, one of the key things that we've done in specific situations where it is a competitive marketplace and there may be multiple multiple bidders on a house is actually provided you with the information and you've ran through it
Mhm.
so that you can say, well, yes, on this house we can go up to this amount
Mhm.
on the property.
Yeah. So we can get really specific in regards to pre-approval process, even though the lenders are not really looking at your documents. That's one of the things that I can do. So we underwrite, or I underwrite all the deals. I will ask for all your documents up front. We do run your credit and we do confirm down payment so that I can verify that you qualify for a mortgage, and then we can submit it for a rate hold. So we know exactly what you qualify for before you go shopping.
Oh, that's good news. And especially if you are in a competitive situation, having this information in your back pocket and even having some documentation to put through with your offer can help sway the buyer into looking at you. Because in some cases, some buyers will go and get a pre-approval, not a pre-qualification, and put in an offer of no conditions, including financing, and thinking that they can be financed, and then later on.
Find out you don't qualify. Yeah.
Mhm.
So we use examples all the time where you can do those quick qualifications online, 60 seconds and see what you're approved for. The problem with that is that if you don't have somebody who's actually looking at all the documents, there may be some differences in the income that we may not be able to use. So you may not qualify for exactly what you think you qualify for. So it's really important to make sure that before you go shopping with a realtor, that you have everything verified with a mortgage broker first.
Okay, well, that's really good news. Now, so once you get pre-approved, so the next stop is, okay. Well, down payments, okay, and there's a high ratio lending, and then there's conventional mortgages. How does this all
Mhm. So we have different down payment requirements depending on what you're getting.
work?
So if you are a buying a house that you're going to be living in, you can put as little as 5% down, which is great because that really helps people try to get in the house. If you're buying a rental or investment property that you're not going to be living in, then 20% is required.
Hmm.
So that's really important to know because some people don't realize that you need a large down payment for those types of investment properties.
So with the investment properties, um, do some banks or lenders shy away from investment properties, and or most of them will allow you to buy a rental property.
As long as you can qualify, then buying a rental property is not an issue with a lender. All lenders usually have rental programs available. And one of the great things about rental properties, if you're buying one, is that you can use the potential rental income to help you qualify, which a lot of people don't know either. So
Oh,
we
okay.
just proved that with an appraisal with market rents,
Mhm.
and we can add that to the application as income. So that's great.
Okay. Now, with some banks or financial institutions or lenders, they'll take different amounts of your rent. Will they put forward a mortgage?
hmm
Correct?
Yeah. So
Mhm.
each lender works a little differently. So one of the great things with being a mortgage broker is we get to shop around with different lenders, and that allows us to find lenders who will use a higher rental income towards your application. So some use 100%, some use 50%, and that depends if we're at A type lending or B type lending.
Okay. Well, that's great. Now, with regards to where can this down payment come from?
Mhm.
Okay.
So that's a big question that we get a lot. Where can I source my down payment from? So down payment can come from your savings. Most people do save it over time. Another source of down payment can be gifted. So you can get funds from an immediate family member that can be deposited into your account, and it is called a gifted down payment that we use from a family member.
Oh, fantastic. And if the family member doesn't necessarily have it, they could actually mortgage it against
Yeah,
your line of credit. They could
you can
get,
get creative. You can
yeah.
you can also use what a lot of people don't know. It's called a borrowed down payment, and that's where you actually borrow it from yourself, and you borrow it off a line of credit or even a credit card.
Oh, okay. All
Yeah.
right. Well, I thought I didn't think that would be a
You
something to do.
have to be able to qualify for the payment that you will incur due to borrowing off of
Okay.
it. So if you qualify, then yeah, it's a great
Oh,
option.
okay. All right. So, are there government programs? I've heard of a few of them that
Mhm.
people can utilize.
Yeah, we also have RSPs for first-time home buyers where they can use up to $35,000 from their RSPs. And we also have grant programs where they'll gift you up to 10% of the down payment.
Oh, really? Okay,
Mhm.
so that works out well. And once you get all that situated, then would that affect your rate? Like more of a down payment than not?
No, it doesn't affect your rate in regards to the down payment.
Okay,
Mhm.
all right, great. So, I guess the next thing that we have to look at is income. Where
Mhm.
is it coming from? Because in the gig economy, we're having people who may have a couple jobs, they might have a side gig, they might freelance and so on, and may not just necessarily have like a T4 that they
Mhm.
could actually easily show in proof of income. So,
Yeah.
what do we do there?
So income is the one of the hardest things that we have to prove. So it can become very, challenging sometimes. But the great thing is with all the lenders we have, each of them have really a different niche and different programs available for people who don't necessarily fit in the box of regular income. So, for example, one of the great programs we use a lot is Business for Self Stated Income. And that's for business owners who are writing down a lot of expenses, which we want to do because we don't want to claim, those
Yeah.
we don't want to pay the high taxes.
Mhm.
So we're writing down a lot of expenses, but the problem is when you do that, you don't qualify for anything.
Mhm.
So the lenders have recognized this, and what they've done is put together this stated income program. And we use 6 to 12 months bank statements. We take your deposits and then we minus some expenses. We are able to qualify business for self people so much higher than if we were to have to use their net income. So this has been a really, really great program that we've been able to utilize.
Oh, that's fantastic because it's nice that they kind of realize that expenses
Yeah, it's
aren't necessarily well. There may be some play in where if they're
exactly
business related,
right.
that business and business expense and personal expense kind of flow back and forth on it.
Exactly. So when they can see the money coming in, then they'll base the approval based on the deposits. So
Okay, all
yeah.
right. Now, no. So, is there any special programs like for doctors or
Mhm.
professionals that are available?
Yeah, so a lot of lenders have what's called professional programs for professionals, doctors, and
Hmm.
such that we can get approved, and they even get some special rates sometimes. So,
Oh,
hmm
that's fantastic. Um, so now, if you're working with on commissions or bonuses, and or maybe you're semi-retired, what can you do
hmm
there?
So we have some different programs. High net worth is one. So for clients who have lower income, but they have really a lot of investments, we can actually approve them based off their net worth, which is
Hmm.
a really great program we've been able to utilize. There's also for commission people and bonus. Um, we can get them approved no problem, and we can use the higher income with their bonuses. We just need to have a 2 year average. So two
Okay.
years for that, and
Mhm.
then we qualify them on the average.
Okay. So, what are some of the stops on an application for a self-employed that you actually see quite a bit of, they're trying to be pre-qualified, but then there's certain things that haven't been taken care of, such as Revenue Canada.
Yeah, pay your taxes. We can actually, if we're doing a refinance, we can actually roll in the taxes
Hmm.
into the mortgage. So some people who they get away from them a little bit, there is the option to do that. When
Hmm.
we're purchasing, though, it's really important that they're going to want to see those paid off prior to closing.
Okay, yeah, because I guess Revenue Canada has a higher priority to come and
Yeah,
grab money. Okay, fair enough. Okay, so remember, pay your
pay your
taxes.
taxes.
So a lot of people will look at will be looking at their credit score. Okay,
Mhm.
and so this is like they could get free credit scores, or they could go into TransUnion or Equifax and get their credit score. But what are lenders actually looking for
Mhm.
when you look at a credit score?
So when we pull credit, we have the option to pull both Equifax and TransUnion, but all lenders will pull Equifax. So that's what we like to base it off of.
Mhm.
Credit Karma bases your credit score off of TransUnion. And so if you wanted a free version of your Equifax, you can actually go to Borrowell, and they will give you your Equifax score
Okay, so it's more of an accurate or more um,
for mortgage
agreed
purposes.
upon
For
for
mortgage
mortgages.
purposes, yeah.
Okay, and now what with your credit score itself? Okay, does it mean okay? Well, as long as I pay my bills, I'm okay, or does it equate to how much different things that I use in my credit history and my such?
Yeah, the calculation itself. So what lenders are looking for, and it's a really good rule to follow, is the 2-2-2 rule. So lenders are looking for two credit cards for 2 years with at least 2,000 minimum limit. And that's what they're really basing the credit score when they're looking at it. If you don't have that, they don't consider it a really firm or
Hmm.
good credits. Not good. What is the basis foundation? Foundation.
Yeah, yeah,
Yeah,
yeah.
a good
Okay, yeah,
foundation for your credit.
yeah. They can't figure out. Okay, well, yeah. There's proven history or track
Right.
history on it. Now, if somebody's carrying high debt,
Mhm.
consumer debt, okay, with what they with all their credit cards and such, okay, is there some sort of number that they should be behind on credit card utilization and so on?
So we want to, I mean, the quickest way to get your credit score up is really keeping your debts under 30%. Okay.
Mhm.
If your debts go above 30% of your limit, even if you're making your minimum payment, your credit score is going to go down. So a lot of people don't understand, like, why is my credit score going down? I'm making my minimum payments. But if you have that balance that's above the 30% threshold, it will actually lower. So the two things that you can do to get your credit score up the quickest are to lower the balances under 30% of the limit. And also, 35% of your credit score is actually calculated by paying on time. So
Mhm.
it's really important to do those two things: bring down the balances and pay them on time.
Okay. I had a deal get killed because my client had a dispute, and it was like 5 years in the past.
Mm,
They had a dispute and didn't pay a bill, and it got nailed on her credit score as a like a default or something
mhm.
like that, and it really affected her mortgageability after 5 years.
Yeah.
Yeah. And so what's a good credit score then?
perfect credit score, and we call them a unicorn, is 900. So you want to be a unicorn. I've only seen, I think, two in my years of being a
Yeah.
mortgage broker, like an actual 900.
Mhm.
So we like to keep those. For mortgage purposes, if you're looking at your credit score and you want to stay with the A lenders, they want to see at least a 680.
Mhm.
Okay, so
Mhm.
that's what we want to keep.
So, what are some of the things that people should stay away from whenever you're trying to planning and saving for a house and qualifying for a mortgage? What are some things that they should look for, and what are some of the traps that you're finding people falling into?
Do not buy a car. Do not.
Well, you can buy a bicycle almost as much as a car.
The car payments will kill you if you are looking for or to get into the market, especially for first time home buyers, or even if you're looking to refinance. Really take time to look at when you're going to be purchasing that vehicle, because a $400 car payment will reduce your mortgage eligibility by $100,000. So that's a huge number.
So even if you get like 0% interest and so on, it's not a good deal if you can't buy a house.
And it's not based, they're going to look at the payment itself, not the balance owing. So even if you have, you're paying that down, um, it doesn't matter because it's still whatever the payment is. That's what they calculate it by.
So would it be wise to, if you had a car payment, to maybe get a line of credit, pay off the car, and then with the line of credit and reduce your monthly payment?
you well, for most car loans, if you have the choice, let's say it this way, if you have the choice and you have money to put down on a debt, focus all of your efforts on paying down your credit card and line of credits. That will, because the lenders are actually looking at those balances, you can actually help your qualification by paying those off. Don't put money down on the car because it doesn't matter what the balance is on the car. They're going to take the payment no
Mm,
matter what. So
okay.
focus your finances on the actual debt.
Okay. Good good advice. Okay. So now what are some of the uh, programs, and like I've had people ask, well, will somebody do like a rent to own and so on?
Mhm.
I think those things are available, but there's a few caveats that we have to look at for those.
Mhm. So if you're looking outside of kind of traditional lending, then there are a few programs available. One of them is the grant program. So that depends on the county that you're in. I
Mhm.
know Simcoe County and Dufferin County both have grant programs available, and they will gift you 10% for a down payment. Now, to be in that program, you have to have good credit.
Mhm.
Okay, so
Mhm.
that's really important. And you also have to have good income to be able to qualify. So that's a great program.
Okay, fair, fantastic. Now, okay, here's a quick question, just thought of it. Okay, we're talking about good credit. Okay,
Hmm.
besides like a judgment and a consumer proposal, which is really bad. Okay, how long will it take somebody to repair their credit?
So if you have done a consumer proposal, then before an A lender will look at you, it has to be 2 years of reestablished credit. So that means the
Mhm.
consumer proposal has been finished and you have had 2 years of reestablished credit. On the B side, the B lenders will take you one day after discharge.
Okay, so what? Really?
Yeah.
Oh, okay. A B lender would be, what's an example of a B lender?
So the difference between an A lender and a B lender, all B lenders, you have to have 20% down. So that's non-negotiable. And the A lenders, you can put as little as 5% down. The B lenders, their rates are a little bit higher, not too bad,
Hmm.
but all lenders, B lenders will have a 1% lender fee. So that has to be added into the equation.
Okay.
So 1% of the mortgage amount.
Okay, fair enough. And so your A lenders would be like your banks.
Banks, monolines, yeah.
Okay, all right, fair enough. Now with the now in the with the stress test that's out
Hmm.
with the the big banks and your credit unions, how does that change things?
You with the stress test, you obviously don't qualify for as much. But we do have lenders, especially on the B side, who have no stress test options. So we
Okay,
can actually qualify you without having to use the stress test, especially the credit unions.
okay.
Mhm.
And I guess with things moving around in the the lending community, there's changes in the like amortization periods and this type of stuff in your debt service ratios and such.
Mhm. Yeah, for on the A side, we especially for insured mortgages where we're putting less than 25% down, we have to do 25-year amortization. We
Hmm.
can't do the longer amortizations. But if we go to conventional mortgages where we're putting more than 20% down, we can do 30 and even 35 on the B side.
Okay,
Yeah.
so that can cut down a lot on what you're.
Helps you qualify
Yeah.
for more, plus it lowers your payments, which is
Okay,
great.
all right, fantastic. So what happens with like a rental scenario?
hmm Yeah, so we have two companies that we work with very closely. It's very important if you are looking at a rent to own that you use a company who's established. They're
Okay,
not they're not highly regulated, but they are starting to be regulated. So, and if you want to know those companies, by all means, let me know.
okay.
With the rent to own, we a lot of people think that you don't need a down payment for a
Hmm.
rent to own,
Right.
but you actually do. You need
Oh.
at least 3% or 5%, depending on the company, to
Hmm.
get started with the rent to own.
Okay.
They're a great program, but be aware that payments are much higher.
Are they?
And
Mhm.
that's because they force a down payment.
Okay.
So you're going to pay rent plus future down payment in
Hmm.
your monthly payment, which makes the payments a little bit higher. So people who are doing rent to owns, we usually like to see um, that they have a little bit of a down payment and that they have enough income to cover those higher down payments for usually about a 3-year term until they buy the property off the investor.
Okay. And now, would you recommend somebody? Because I've heard of owners doing like the landlords actually doing that for their tenants. Is that is
Vendors
that is that a good idea or not? Or
can be just
Mhm.
you have to make sure that you do your due diligence and have a lawyer involved in those.
Mhm. Okay, fantastic. Well, I hope you found that this was enjoyable. I've really enjoyed it, and providing you information on making your dreams come true. Now, if you find this content that is useful, certainly hit the like, subscribe, follow the channel. Hope to do more of this for everybody. We've been You have not seen the laughter behind the camera. We've had a great time doing this, and it actually has been educational for myself as well. So, if you wish to talk to Tara or myself, down below are the contact details, so you can talk to us by email, in person, by Zoom, and we're more than happy to help you out with your situation. We've been working together for the last 3 or 4 years.
Years, yeah.
Yeah, exactly. Yeah, and have been able to help out quite a few people live out their dreams. So, thanks a lot. Okay. See you
Bye.
later.